Hi, my name is Vincent Scarcella, Director of Research and Investment Development here at Scroy Financial. Joined with me here today is Gregory Murphy. Greg is Vice President and External Advisor Consultant for PIMCO Investments, covering upstate New York. He's responsible for sales and distributions of retail mutual funds, managed accounts, and other investment products to broker-dealer, independent, and financial institution representatives in Western Syracuse, Rochester, and Buffalo, New York. Greg has 33 years of investment and financial services experiences and holds an undergraduate degree in psychology from the University of Massachusetts. And given the volatility that we have seen this year in the bond markets, Scroy thought it was very important to grab someone that we thought is the best of the best to explain just what's going on in the bond market this year. You know, we've definitely seen a ton of volatility. So with that, Greg, take it away.
Hey, thanks, Vin. I I was reminiscing earlier today about the differences between the virtual seminar and the normal seminar setting, and because I've been doing a number of seminars over the years, I'd hate to tell you for how long. I guess I will. I've been doing this for about 33 years, and I'm one of these crazies that actually enjoys getting up in front of groups. And I find it, believe it or not, far less stressful to do them in person than to do them in front of a camera. And I think maybe part of that is because I've been doing it for 33 years. The downside to that is that I've got a lot more wrinkles than I did when I started when I was Vinny's age. And so long story short, I've been at this a long time. I have, in all honesty, in my 33 years, I have not seen a market like this. We knew it was coming, I guess, and we just didn't really know to what extent it was going to hit the fixed income market. So I'll get into a little bit of that as I go. If anybody has any questions, feel free. This is your evening. Feel free to go ahead and send those in via the chat feature, and we'll try and address those at the end. But I always like to start things off, and I was thinking, like I said, what are the differences between the virtual and the face-to-face? And one of the differences is that I often get a laugh or two out of this story, but it is a true story. And so the problem with the virtual is you can't hear anybody laugh. And so you always think that your stories, if in fact they are funny, you're not hearing a thing, so you think you're dying. So the truth is that I was back in New England. I'm originally from New England. I didn't admit to that for a long, long time, given the growing hatred that existed between the folks in Buffalo and the folks in New England. But I want to say, I think officially at this stage, we can say that the baton has been passed, and that you folks are in the, we'll call it, and I don't want to jinx it, in the midst of what I consider to be the best team in the NFL right now. And so, though I haven't completely jumped ship, I am, in fact, we'll call it a subordinate Bills fan. And so it's a great year from that perspective. So that having been said, I was back in New England this past summer, and I ran into a good friend of mine, and he's a very successful business owner, and he runs a motel with an adjacent restaurant, and he's a really, really funny guy, and I still call him boss because, believe it or not, I worked for him back when I was super young. And I said, "Hey, boss, how's it going?" He says, "Oh, it's going great, Murph." I said, "Bookie's everything good?" He goes, yeah. He goes, "Steady she goes." I said, "Well, how's he doing?" He knew what I was mentioning, and that's his son, who's also a friend of mine. He goes, "Oh, he's doing fine. He's got a new career." And I said, "Okay, that's cool." He said, "Yeah, he's a waiter now." And I said, "Oh, all right, that's good." And he says, "Yeah, he's waiting for me to die." So that's his idea on how to plan a couple of college tuitions for his children and his retirement for both he and his wife. So I'm just going to assume that everybody thought that was funny, so I'm going to move on. So at this stage, the elephant in the room is that this is the worst bond market that we've seen honestly in decades. And I've heard a number of different years quoted on this, and I'm going to stick with 1931. And so we went right past 1994, which I do remember firsthand. We certainly went past 2013 with the taper tantrum, went right through 94, went through 49, and now we're hovering somewhere around 31. The problem is that the data gets very, very murky. Once you get past, we'll call it the 70s, the data becomes really tricky to mine out. But it has been a very difficult bond market, and we do not, in any way, shape, or form, with any of the things that I'm going to say or with any of the stuff that we're going to talk about, we do not take this lightly. We totally understand that if we, as a manager of fixed income and are managing a fund of yours, and that fund might, let's say, be down 10% versus its peer group who's down 12, we still get that you're down 10%, and we still understand that that is not that's not super comfortable. And so we're doing everything we can. I can tell you we're working day and night to try and make sure that we're managing this stuff as effectively as possible. But the problem is that we have a Fed who is, for lack of a better way to put it, hell-bent on keeping inflation in check. And I get that whole idea. I get that whole thought process. I truly do. Like I said, I was around for the Volcker days. I remember how Paul used to consider inflation to be the all manner of evil. And the one difference that I would cite today versus 94 was that the economic condition today is a lot different than it was in 1994. We do have a lot of, we'll call it economic headwind as a result of political risk, and I'm certainly not going to get into that at all, but we do have a lot of stuff going on that wasn't going on in the 90s. But I think that Volcker was doing the right thing at the time. He did raise. I do think that Chairman Powell has taken a page out of his playbook. He's doing the right thing, but the problem is we might have, we'll just call it, been a little bit too easy with the money supply to begin with, and we're now having to taper off of it. And anytime you taper a patient off of any kind of medication, sometimes the patient has side effects, and we're feeling the side effects as we speak. And so in this process of bringing us down, of bringing us out of this, we'll call it quagmire, Powell has had to raise rates. And I do think that the idea of an overshoot does exist. And I want to pause for a minute and kind of talk a little bit about that. An overshoot meaning if he were to raise too much, certainly the bond market has been enormously affected by this. If he were to raise too much, and we were to have clients who are, certainly everybody's adversely affected by inflation, but if we were to have clients who are so, we'll call it, nervous about their bond products, and that they were to make a real mistake here at this point and liquidate out of those bond products, does it really behoove us to, we'll call it, blow up the bond market and have that person get out and in some cases lose a lot of money by liquidating at the wrong time, at the idea of trying to save them money on, we'll call it, higher gas prices and higher food prices. So it's a real conundrum. It's a conundrum wrapped in an enigma. And so essentially what he's trying to do is he's trying to draw prices down. The problem with that is that inflation has been very pesky. It went from, some of you may have recalled from, various interviews on either CNBC or Bloomberg, the idea of transitory inflation, which essentially meant that the inflationary scenario was probably going to come and go pretty quickly. We at PIMCO weren't necessarily in that camp. I didn't believe it personally. I did think that we were going to have more inflation than a transitory scenario. But I didn't necessarily think that it was going to, stick around for 3 or 4 years like it has in the past. If you look back in history, if you go from 73 to 83, it was a decade. And I think that this is where people are now. If they've done their research, this is where people are really getting sort of wrapped up in the gears, is if you look from 73 to 83, and a lot of people remember that, that you had, an average inflation rate of somewhere around 9.5%. That was really treacherous, and I get that. We don't necessarily believe that we're going to have anything like that. As a matter of fact, I want to talk a little bit about rates, and I want to talk a little bit about the inflationary effect and what we think is going to happen. So again, a lot of this is very difficult to call in an environment like this. We at PIMCO have had a great I'll call it, track record of predicting crises in the fixed income markets and interest rates and so forth and so on. But this one's been very, very, very difficult. So if in fact inflation were to come down, let's say towards the end of the year, if in fact it were to take into 2023, that's not the end of the world. That's okay. And one of the things that Janet Yellen said that I think is really, really important, she said, everybody is getting really concerned about inflation. Inflation can be difficult, but you have to remember inflation is a heck of a lot better than a recession. The problem is that the potential for a recession is pretty significant. The good news is that we might be in the midst of a recession as we speak. And so we may be working our way out of that sooner rather than later. And so what we're thinking could potentially happen is that the Fed is more than likely going to raise by 75 basis points in November. They're more than likely going to raise by, we'll call it 75, 50, or 25. It's vacillating quite a bit now. I think personally it's probably going to be a 50 basis point increase. But at that point, and I do think that the rhetoric from Powell is going to be very, very important to watch this time, because I think what you're going to find, and listen for this if you do have the time to watch, I think that the rhetoric is going to be such that he's going to give himself a lot of wiggle room here to potentially cut less or potentially not cut at all. And so if that happens, it will send a clear signal that they may be done with that process of raising. And at that stage, we could go into at least an even keel with respect to rates. And if we get to the point where we're at, we'll call it sort of an even keel on rates, then what can happen is that these yields, the really silver lining to this whole story is that the yields have come up considerably. I haven't seen yields like this in 20 years. And so these yields can kick in and act as ballast. And so let me talk a little bit less technical for the remainder of my 10 or so minutes. I want to talk a little bit about a story because, like I said, this stuff can roll around in our brains and make us really dislike investing more so than ever before. And so I want to try and kind of finish up my talk on a positive note. And keep in mind, like I said, we think, especially from the fixed income perspective, that most of the bloodletting, most of the difficulties are behind us. And staying the course is exceptionally important. And so if you've heard a couple of, we'll call them nautical analogies, as you can see behind me, I've got a chart behind me. I'm a fan of boats, and I'm a fan of the ocean, and I'm sort of a historian at heart. And so I built a little story back towards the beginning of the year, and I called it Boats and Bonds. They're not that much different. And so I want to do kind of a three mini story discussion here, just to, like I said, make a little bit more light of the situation. And so back in the 1800s, there was we'll call it a technological marvel at the time. And that technological marvel was the idea of using whale oil to illuminate streets with, those, you've probably never seen one because they don't exist anymore, but those old-fashioned lanterns were, like I said, at that stage, they were a technological marvel. And what they did was they allowed for a town or a city to have people go out and walk at night and feel more safe. It allowed for businesses to stay open later. It was almost, in a sense, an old-fashioned internet because, again, it allowed for light. We take it for granted like crazy these days, but back then, they didn't have that. And the whale oil was essential to that process. And so we'll call it the 1880s. And my first boat is a whaling galleon. And these individuals, mostly men at the time, they would go out in these ships in the North Atlantic. And I can tell you, going out there in August is fun. Going out there in November or December is beyond scary. And they would go out, and honestly, they didn't know if they were coming back. But again, it was essential that they harvested this oil for the streets. And so often they would wreck, and the tales that would come back to the coast were that they were either devoured by a three-headed serpent of some kind. We've seen those in our history books. They were either succumbed by the kraken, the octopus, or they were taken down by Moby Dick. And so that was the myth. Well, the reality was that most of those wrecks, most of those crashes were as a result of pilot error. And in an environment like this, though it's extremely potentially lucrative for fixed income investment firms like mine to go out and buy all sorts of new ideas, we're not getting greedy here. So moral number one, separate the myth from the reality. The myth was that the Kraken was going to take down the ship. The reality was it was pilot error, and we at PIMCO try never to have pilot error. We're not going to get greedy, and we're not going to try and sail into uncharted waters. Story number two is a more modern story, and that's the Boston whaler. Small boat, very seaworthy. And I'm going to fast forward to 1980. In 1980, I looked a lot more like Vinny. I had a lot more hair. And in the 80s, let's just say that the oversight, the parental oversight, wasn't necessarily what it is today. And so if you were a kid, let's say 18 years old in 1980, and you lived near the shore, boats were a fun thing to use, even into this time of year. And we were in a Boston whaler one time, me and my best friend, and we decided that we were going to play chicken. This was something that we actually did do. We were going to play chicken with another friend of ours in another Boston whaler. And the moral of the story is don't ever do that. But the bottom line is we did, and we were the last to turn at the last second. My friend got ejected from the boat. The problem was that there was still a little bit of fuel left in the engine, and so it was coming around to finish him off. And so I grabbed a hold of the rail, and all I could think of was, if the ballast doesn't kick in to make this thing come upright, and I can't get to the wheel in time, he's in big trouble. So I was able to get to the wheel, the ballast did kick in, and all was good. But the moral of that story is that the ballast in the bond market is, in fact, as I had mentioned before, those higher yields. So as I had mentioned, if we can just get the Fed to level off on rates, if we can just get rates to level off along the yield curve, guess what? The newer, higher yields, we're able to find 4s, 5s, 6s, and 7s in the marketplace today with way lower than you would imagine risk, okay? And so these yields can kick in and act as ballast to right the ship. And lastly, in 2008, I finally succumbed to going on a whale watch. And so I told my wife at the time, I said, listen, I this is a touristy thing to do. I'm from New England. I don't want to do this. And she's like, no, the kids are going to love it. And so we went out, and it was absolutely phenomenal. Okay. I would recommend it to anyone. Absolute blast. And so the kids had a blast, and we're out there, and it was a nice day, and we were seeing all sorts of whales. And, the geek in me kicks in, and I'm thinking to myself, why in the heck, if we are out looking at underwater mammals, and we know that they submerge and they don't reemerge in the same place twice, why are we chasing these things around? Why wouldn't we just get to where the pod is, okay, get in the middle of the pod and watch from there? And fast forward to today, that's exactly what they do. But at the time, they had just started it. And what they'd do is they'd see one surface, they'd chase after it. And of course, they didn't know where they were going. But the good news, the moral of the story is that we got a chance to see a ton of whales. And like I said, the geek in me kicked in, and I said, wait a second. There's a story here. And that is that if you get in the pod, all right, in with the family, in with the right group, meaning a combination of SCROI as your oversight, as your management firm, and PIMCO in we'll call it the investment universe, the fixed income specialists being around since 1970, you have an award-winning combination there. And so though it's been tricky, though it's been difficult, both from an equity perspective and a fixed income perspective, it's been exceedingly difficult to find even, a minor positive rate of return from anything this year. Know that we know that, and know that we're working diligently to protect and to take advantage of the buying opportunities that we see specifically in the fixed income marketplace. And so that puts me at about almost exactly 20 minutes, which is what I had promised my friends over at Scroy. And so what I'd love to do now is I'd love to open it up to a Q&A and answer any questions that you folks may have. Thomas, I wish I could be there to hug you in person. And so I'm assuming that at least one or two of you are laughing at that. No, what Thomas has asked is, I guess in a nutshell, it's a really good time to invest in bonds. And it's such a good time to invest in bonds that I'm finding myself having to say, okay, hold on there, big guy, be careful, because a lot of people are talking about what's called drawing in the duration of their product, okay? And I'll do a very, very brief tutorial on what that means. All that really means is in a bond portfolio, you can have what's called duration. And essentially what that means is the number of bonds in the portfolio that are 3-year in maturity or 5-year in maturity or 7-year in maturity varies, right? And so you can have a duration of, let's say, 1 year, which is exceptionally safe, all right? That's, I don't want to say as safe as you can get, but it's close. And so a lot of people have been talking about, well, let's draw in our duration because we do think that the Fed is going to raise a couple more times. And if in fact they do, bond prices could go down a little bit more. That is true. But the problem is you have to fight the urge to what we call bottom fish. All right. So in other words, you have to fight the urge to say, we have the capability as individuals to kind of time the bond market. If you're doing that, you're in effect starting to look like you're trying to time the bond market. So you got to be very careful of that. And so what I've been trying to talk about is, listen, I get that, but you do not want to be taking from a product that's, like I said before, down maybe 10% or 9% or 8% and go into something that is a much lower duration. Let's say we'll call it a money market type of product, because getting back in time is really, really difficult, if not impossible, because what you're essentially doing is you're in effect locking in that loss. Yes, that the other product that you go into is going to do okay, but it's not going to do potentially as well as the one that you were in initially. So be careful of drawing in that duration. I've been talking to people about long-term U.S. government bonds. And by the way, I am not, by any stretch of the imagination, making recommendations to buy a portfolio of long-term U.S. government bonds. But if you are an opportunistic investor, as my friend just pointed out, we've got a long-term U.S. government bond portfolio that's down 31% year to date. And I've never seen anything like that before. And again, these are government bonds. And so there's two sides of that story. So if you want to take advantage of this situation, you can do something like that. Or you can, like I said before, you can kind of cover up and ride it out a little bit, in the sense that, things could go down a little bit more, but be careful with that. I would err more on the side of adding duration than drawing it in.
And then, Greg, I have a question for you, if you do not mind. This call is actually pretty good timing because, as you alluded to earlier in this call, tomorrow, big day for the Fed, most likely going to raise by 75 basis points. So I just was wondering if you could just speak on the idea of this Fed pivot and what it could possibly mean for the bond market. Hearing CNBC, Fox News, whatever it may be, they're constantly kind of talking about Fed pivots and all of that. So I'm just wondering if you could just kind of speak on what an actual Fed pivot does mean possibly for the bond market moving forward, if they do hint at that tomorrow.
Sure. And I did talk a little bit about it, but let me get into a little bit more detail. So it was interesting. One of my competitors had a gentleman on today, and he was really, really good. And he had said, we've got to have an adult in the room. And he said, and I feel like that's been difficult to find these days. And he said, I feel their pain, meaning Chairman Powell. He said, last night I had to literally sneak up on my kids in their bedroom and pull their candy away from them. And he said, nobody wants to take their candy away on Halloween night. And he said, but at the same time, you have to do what's best for them. And so the idea of a pivot is and he went on to talk about the idea that we think that the Fed may be raising possibly a little bit too much to give themselves some additional room to bring rates down in 2023. And there's been a lot of really smart folks talking about the idea of Fed cuts in 2023. Certainly that's a ways away still, but the possibility of Fed reductions, I think, is potentially growing here. And so that would mean, to Vin's point, you'd be pivoting from we'll call it increasing bias to a neutral, and then swinging back towards a cutting bias. And we're not saying that the 10-year could go from, we'll call it, for all intents and purposes, 4% today. We're not saying that the 10-year could go from 4% today to 2% in mid 2023, but we are saying that if the Fed started to cut rates in 2023 by mid-year, you could see the 10-year come down by 25, 50, or potentially even more basis points than that. So that's the brief definition of a pivot, and we do believe that the potential for that is pretty significant.
Awesome. And it looks like we actually do not have any other questions as of now. So with that, we could definitely wrap this call up here tonight. I just want to thank everyone for joining us, and especially want to thank Greg for taking time out of his night to talk about the state of the bond market for everyone that is watching. So once again, thank you everyone for joining, and Greg, thank you very much for joining as well.
You're very welcome. Thanks everybody for your time. I very much appreciate it. And if you have any questions, you can certainly field those over to Vince. But have a wonderful evening, everyone.
Take care, everybody.
Bye-bye.